Costco is trading at one of its most attractive valuation levels relative to its recent history. And historically, every similar setup since 2016 eventually turned into a buying opportunity. But there is one major problem. Costco is still trading at around 46 times earnings. So is Costco actually cheap right now? Or is this a value trap hiding behind an expensive stock? Let's look at the data. In this video, I'm going to analyze Costco using several different fundamental indicators. We will start with the P/S ratio and operating income valuation, where Costco is flashing levels that have historically appeared around major buying opportunities. Then, we will look at one of my favorite forward-looking valuation signals, which recently triggered for only the 8th time since 1994. But after that, we need to address the biggest risk in the data: Costco's extremely high trailing P/E ratio. And finally, we will look at revenue growth and profit margin to see whether the fundamentals of the business can actually support this valuation over the next several years. Let's start with the P/S ratio. This indicator compares Costco's current price to sales ratio with its own 2-year average. Instead of simply asking whether Costco's P/S ratio is high or low, I want to know whether it is expensive or cheap compared with where investors have been willing to value Costco recently. And since 2016, something very interesting has happened. Every time this indicator dropped below -1 standard deviation, Costco eventually entered another bull run. Now, that does not mean the stock immediately bottomed every time. Some of these undervalued periods lasted longer than others. But historically, these levels have been very attractive entry points. For example, in November 2016, Costco dipped into this undervalued region and was followed by a roughly 25% rally over the next 6 months. Another signal in 2017 was followed by approximately a 50% gain over the following year. In January 2019, we saw another major dip. Costco then gained roughly 80% over the next 24 months. March 2021 gave us another signal, followed by an approximately 80% rally in just 12 months. Then between the summer of 2022 and summer of 2023, Costco went through a longer consolidation period. The indicator moved below -1 standard deviation, stayed relatively depressed for some time, and eventually Costco broke out. Over the following 24 months, the stock gained roughly 100%. Most recently, the indicator briefly touched -1 in January 2026. Costco subsequently rallied around 10%. But here's where the things get more interesting. Today, this indicator is sitting around -1.4 standard deviations. So Costco is now even cheaper relative to its recent P/S history than it was during that January signal. Historically, this has been an attractive region. But remember, valuation is not a timing tool. Costco could remain undervalued for weeks or months before the next major move begins. And this isn't just the P/S ratio giving us this signal. If we compare Costco's valuation with its operating income, we see almost exactly the same pattern. Historically, when this indicator dropped below -1 standard deviation, Costco was once again trading near levels that preceded strong future performance. Right now, it is sitting at approximately -1.7 standard deviation. So we now have two separate fundamental measures telling us essentially the same thing. Relative to sales and relative to operating income, Costco is trading unusually cheaply. compared with its recent valuation. But this is where the analysis gets complicated. Because if we look at Costco's traditional P to E ratio, the stock doesn't look cheap at all. Costco's trailing 12 months P to E ratio historically struggled to remain above roughly 45 times earnings. For years, that area acted almost like an upper valuation boundary. But something changed around 2024. Costco broke above 45 times earnings, and since then, the P to E ratio has mostly oscillated between roughly 45 and 65. Currently, it's sitting around 46 times earnings. And that's important because despite the attractive relative valuation signals we just looked at, Costco is still trading at an extremely high earnings multiple compared with much of its history. There are two possible interpretations here. The first is bearish. Costco remains fundamentally expensive, and eventually its valuation could compress back toward historical levels. But there's another possibility. The market may have permanently repriced Costco and is now willing to pay a higher multiple for the business than it did historically. Since 2024, we have repeatedly seen Costco maintain a P2E above levels that previously represented major tops. So perhaps 45 plus is becoming a new valuation regime. We don't know that yet, and that's exactly why I would keep watching this indicator. The P2S and operating income signals are attractive, but the trailing P2E is the biggest piece of evidence telling us not to become blindly bullish. Now, let's look at another indicator that gives us a more forward looking view. This compares Costco's historical earnings valuation with its forward earnings valuation. When this ratio rises above roughly 1.2, it tells us that expected future earnings are making the stock look significantly cheaper than its trailing earnings suggest. And historically, this has been extremely rare signal. Since 1994, it has happened only 8 times. Before the current signal, the previous 7 were followed by rallies of approximately 730, 37, 150, 350, 150, 70, and 150%. These rallies lasted anywhere from roughly 1 year to 8 years. Obviously, I don't expect Costco to automatically repeat those returns. That's not how historical analysis works. But the consistency of the signal is difficult to ignore. And the eighth signal appeared in January 2026. From that signal through August 8th, Costco has gained only around 10%. If the historical pattern continues, that would suggest the current move may still be relatively early. And this is probably the most bullish part of the entire analysis. The trailing P2E looks expensive, but when we incorporate expected earnings, the valuation picture becomes much more attractive. So now the question becomes, can Costco fundamentals support higher prices? Looking at revenue expectations, analysts are still projecting consistent revenue growth over the next 5 years. The concern is the rate of that growth. Year over year revenue growth is expected to gradually decline from around 9% toward roughly 5%. On its own, that wouldn't exactly justify paying an enormous valuation premium. But revenue growth isn't the whole story. Costco has also become increasingly profitable. Since around 2010, Costco's net profit margin has consistently moved higher. It increased from roughly 1.5% to around 3% by 2026. That may not sound dramatic, but Costco operates a massive revenue base. Small improvements in margins can therefore have a meaningful impact on total earnings. So even if revenue growth slows over the next several years, continued margin expansion could partially offset that slowdown. Costco doesn't necessarily need explosive revenue growth if it can convert a larger percentage of every dollar of revenue into profit. And that becomes especially important when evaluating whether today's higher P/E multiple can be justified. So, where does all of this leave Costco? I see three major signals. First, the P to S ratio is around negative 1.4 standard deviations compared with its 2-year average, a region that has historically produced attractive buying opportunities. Second, valuation relative to operating income is even more depressed at around negative 1.7 standard deviations. And third, the historical to forward P/E indicator triggered one of only 8 signals we have seen since 1994, with every previous completed signal followed by a substantial bull run. Those are very bullish signals, but there is one major risk. At roughly 46 times trailing earnings, Costco remains expensive on an absolute basis. Maybe the market has entered a new valuation regime where Costco consistently deserves a P/E above 45. Or maybe we are eventually going to see multiple compression. That's the number I would be watching most closely. For me, the data suggests Costco is becoming increasingly interesting at these levels, but it doesn't tell us that the exact bottom is already in. The stock can remain undervalued relative to its recent history for some time. What the historical data does tell us is that periods like these have repeatedly produced attractive long-term opportunities. If you enjoy this type of data-driven stock analysis, where we look beyond the headlines and actually test today's valuation against decades of historical data, consider subscribing. And I'll see you in the next analysis.